starting your route to retirement.
Welcome to the Guided Retirement Show. I'm Dean Barber, your host, and also founder and CEO of Barber Financial Group. On today's podcast, we're going to be joined by Dr. Randy Anderson. Have you ever thought about owning real estate? And maybe you do own some rental properties today. Maybe you're a sophisticated real estate investor already. Dr. Randy Anderson is going to break down investing in real estate in a bigger way than I think most of you have ever thought of. There are major endowment funds from major universities and state pension funds that invest in real estate, but they typically do it in what is called private real estate that's not publicly traded, or it's real estate that you may not be able to have access to on your own. And Dr. Randy Anderson is going to talk to us not only about how economic conditions affect the overall real estate market, but how diversifying through some investments in real estate can help bring down the overall risk in your investing. I hope you enjoy Dr. Randy Anderson here on the Guided Retirement Show. All right, Randy, I'd love to just start with some basics on the economy, interest rates, and things like that. And I know your specialty is real estate, but with a PhD in economics, a lot of times what we talk about in the financial world really flies over the head of a lot of people out there. So can you kind of break down economic expansions and contractions for us just a little bit to start with?
Sure. Well, obviously, an economic expansion means the economy is growing, and the rate of GDP, which is gross domestic product, was basically it's all the stuff that we buy, it's all the stuff that we consume is increasing. And early on, it usually increases at an increasing rate. It gradually starts to increase at a flat rate, and it gradually starts to increase at a slower rate. Eventually, when it starts to contract, it moves in the other direction. When I think of GDP, whether it's going up or down, I like to sort of simplify it into what the buckets are. Like where is this economic growth coming from? And it can come from several places. The most important place that it comes from is the consumer. The consumer makes up about 70% of the economy. So when the consumer has good jobs, good stability in their jobs, they have good confidence in the economy, they'll spend more money, that creates growth. You have businesses that invest in their business, they invest in product that helps the economy grow. And you really have the government that also spends money to support infrastructure and all the other supports that the government provides. And then you have the difference between how much the economy exports versus imports. And those are really the buckets. And if those things are growing, the economy is generally growing. And if those things start to slip, that's when you start to move into the softer side of the markets.
So if things start to slip, what causes that? Is it because we've got, say, full employment, people aren't making any more money, there aren't any more jobs to be had, job creation starts to slow? What causes that slip generally? If 70% is consumer spending, I've got to imagine that much of the beginning of a contraction would come from the consumer. So what causes them to slow down?
Well, it can be a lot of things, and different things can trigger it, and different things have triggered different economic slowdowns over different time periods. I mean, one thing that you pointed out correctly is when everybody's fully employed, it's just harder for the economy to grow. You know, when you have a bunch of people sort of sitting on the sidelines and they don't have a job, and all of a sudden they get a job, they maybe move out of their parents' house, or maybe they move into a newer apartment. They got to buy more clothes. They do things that create a lot of economic growth. You know, when you sit in a situation like we are today, where everybody's at full employment, you might move from a job to a better job, but that really only increases your savings rate and doesn't really cause that economic growth. So one thing that makes the economy harder to continue to grow forever is that you just get to a point where there's less gas in the tank, and the gas in the tank is really that consumer. And unless that consumer can make enough more money or increase productivity, it becomes very, very hard. Now, other things can happen as well. You could see asset bubbles occur. And when those asset bubbles break, you can have a wealth effect. So, you go back to the global financial crisis, a lot of people had their money tied up in their house. And maybe they took out a second mortgage in order to spend more money to keep that consumption going. Well, all of a sudden the house prices fell, and that wealth that they thought they had, maybe you thought you had $100, $200, $300, $500,000 of wealth in your house, but all of a sudden the house value depreciated. You didn't feel wealthy anymore. And you became more worried about your job. And those effects lead, again, going back to that big consumer, that consumer spending less money, being less confident, and therefore causing that trickle-down effect, the slower growth in the marketplace. It could be the stock market, the same thing like an asset bubble. You can feel that your 401k is building up. You feel that you're more secure in your retirement. You feel that you can spend a few more dollars maybe on a vacation or on clothes or on a trip. But all of a sudden you get a 25% correction, that wealth effect goes away. And again, it goes back to that big bucket of the consumer, where the consumer just doesn't feel as well and has a hard time feeling the economy.
That makes a lot of sense. And so let's relate this back to the global financial crisis where, I think people did over-lever themselves. They borrowed money against their home. They wanted to spend more. You almost couldn't go a day without hearing multiple ads on the radio. If you've got a home and you've got home equity, come see us because we'll loan you up to 110% of the value of your home. And so people got in and they spent this money. They thought it was free. They thought that their house price was going to go up in value enough to just pay that thing off. And all of a sudden, man, it got ugly. And so, a house is down 10 or 15% in value and it's wiping out wealth that you never had.
Yeah. Well, it's funny, when things don't make sense, there's a reason they generally don't make sense. So, going back to the global financial crisis, you had people that were spending, 9, 10 times their income on housing, and that's nowhere near the norm. It's more like 2.5, 3 times is more of a typical multiple. So people, because they were doing things like no income verification loans, hey, you got a pulse, you're willing to sign a document,
right, right.
And people believe that it was riskless in a way because if home prices always go up, if all of a sudden you have a problem and you can't make the mortgage, so what? You can put it on the market and sell it. But the problem is the music always stops. There has to be an economic reality between what you're buying and the ability for people to pay. So, if you have a house, well, what's the value of that house? Well, it might be the value that you rent it out. Well, if you don't have a lot of job growth or strong income growth, who's going to be able to pay for that growing cost of the mortgage? If there are just more houses and apartments than there are households, then all of a sudden you get back to just a basic principle. Anytime there's more supply than demand, the prices can't really sustain themselves. And so, really, if you think back on the global financial crisis, all those things were happening all the way back in 2005. But like a lot of bubbles, they persist a little bit longer. Why? Well, the government didn't really want the market to fall apart, so they kept putting more stimulus in there, and loans got even more aggressive, and let's refinance again, and what it led to was a situation where housing prices were probably already 20 and 25% over what they should have been based on people's income, based on the strength of the economy, but it was able to persist for almost 2 more years with artificially low interest rates and just a continued demand, thinking that, this is going to be temporary if it does slow down. And I really have almost this riskless arbitrage because, of course, housing goes up all the time, even though that broke the principles of supply and demand.
So let's talk a little bit more about that fell apart. And if people hadn't borrowed money, in other words, if they'd paid cash for their house, we wouldn't have had the same issue. So you had loans that were being made, as you said, that were no income verification. You got a pulse, you can fog a mirror, we'll give you a loan, and we'll loan you a lot of money. And so, and you had the interest-only loans where people were buying a house and it was an interest-only payment, balloon in 7 years. But if you didn't have the debt on this real estate at that time, it would have been a totally different story, right?
Well, that's right. I mean, for one, real estate's always been a heavily levered asset. So people will control a lot of assets with a little bit of equity. That's great when things are going up. You get the benefit of leverage. If you are paying something down and you got a 3% interest rate on it and things are going up at 5%, that works really well. The problem is when it goes in the opposite direction, that benefit that you get also gets magnified to the downside. So, people that had low levels of mortgages or no mortgage on their homes, they were able to weather the storm. Now, you might not have been able to sell your home, but if your home was paid for, you could still live. You didn't have to ruin your credit. You didn't have to sell off other assets. You had to just wait a while until you got out of the problem. If you had a low enough mortgage on your house, you could even sell it in the depressed market and take the cash off the table if you needed to, say you lost your job. So, it's a really important lesson, when it comes to any kind of financial asset, maybe real estate in general, because people tend to really over-lever real estate. One of the reasons, there's really 2 reasons people get in trouble with real estate, whether it's a house or commercial real estate. One is They buy everything all at the same time. So, you could be the best real estate buyer in the world. You picked the best house in the best neighborhood, but you bought it in 2006. That didn't work out well, for most people. Now, come along today, you're okay again. But how do you get from that really bad point in time when you bought the home to making it to the other side? That had to do with not being over levered. If you're not over levered, you have the chance to sell it, still get rid of that risk. Maybe you lost money, but you didn't wreck your finances. Or it was such a low level of payment, no mortgage or a small mortgage, even with a lesser job or a smaller bonus, you're able to maintain it, because eventually prices will go up. Prices will go up as the cost of goods and services go up, as inflation kicks back in, as we get to the other side of the economic cycle. But you have to be able to get there. And the easiest way not to get there is having too much leverage on things at the wrong time.
All right, so let's talk about real estate as an investment. And I think a lot of people think of their home as investment real estate. That it's an asset. Well, I know that I've owned a home now for over 30 years, and maybe it's appreciated in value over time, but you got to put a lot of money into that thing. And I look at a home as a place to live, and I look at that totally differently than looking at real estate as an investment. If you're going to invest in real estate, you want that real estate to provide income for you. You want that real estate to provide opportunity for you over the long term, and it's not necessarily a place where you're going to live. So can you talk a little bit about the concept of investment real estate versus just a place to live?
Yeah, absolutely. So, when I think about investing in real estate, I don't think about my house at all. That's not even part of the equation. Other things go into that part of the equation. It doesn't mean that your house can't turn out to be a decent financial reward for you. But when I think about investing, I think about the main ways that investor can get the most return for a given level of risk. And generally speaking, that's to have a diversified portfolio of things that make up sort of the asset market. What are those things? Well, one is just stocks, as we know. So everybody's got some stocks in their portfolio, and that can be done with individual stocks or mutual funds or ETFs or whatever way you want to express that. The second sort of biggest, asset class that people hold are bonds, right? So, corporations need money, and governments need money, and you can get a bond investment. And those, while not have a lot of upside, they're fairly stable, can provide some income. Well, the third biggest asset class really is commercial real estate, investable real estate that can generate income. And I'm a recovering academic, so I spent a long time, over 10 years, editing the Journal Real Estate Portfolio Manager. And all the studies, the first set of studies, it didn't even go back that far ago. So, listen, I can get more return for the risk I'm taking if I don't just have stocks and bonds, if I actually invest in real estate. And the real estate they're talking about is not your house. They're talking about investing in a diversified portfolio of office buildings, industrial property, multifamily, apartment complexes, because those are hard assets. They don't move in the same way the stock market moves. They don't move in the same way the bond market moves. And generally speaking, most of these investment properties have the majority of their returns coming from income to help kind of stabilize out those returns. So, when I think about investing in real estate, I'm not thinking about my house. I'm thinking about my house. I'm thinking about other things. I'm thinking about utility. I'm thinking about, how long I'm going to be in that particular location. I'm thinking about school districts. Hopefully, yes, it becomes a good investment and I can make some money. But when I'm thinking about my portfolio, I'm thinking about the large asset classes out there and how to have a great return to protect my retirement, protect the kids' futures, whether it's school or weddings or whatever it is that your goal is, as you're saying.
Right. See, and I think that what happened back in the financial crisis was people were speculating, right? They were buying and they would move up a house, they'd move up another house, they'd go out and get a more expensive house, and they're seeing how fast this is appreciating, and they're feeling wealthier because this real estate is increasing in value over time. And they made the mistake of thinking, well, this is part of my retirement. This is an investment, when really it shouldn't be looked at that way. It should be looked at as a place to live. So let's talk about this whole concept of the commercial real estate investment, because I think the average person doesn't really understand that there are ways that they can actually diversify their portfolio into commercial real estate, and ways that you all have that doesn't require you to tie up your money or to go out and have to talk to a banker and get a bunch of loans and all that. So can you talk a little bit about how the financial industry has put together diversified portfolios of real estate and things that maybe people should watch out for and opportunities that they should seek out?
Yeah, listen, I think this is the greatest question. I mean, one of the reasons that you saw portfolios back 10, 20 years ago only being stocks and bonds is individuals didn't have a way to actually invest in real estate. I mean, how is the average person, even a much above average person, a person with quite a bit of net worth, how do you go out and buy an office building? How do you go out and buy an apartment building? How do you even know what a good one is if that's not the occupation that you engage in? You'd be a very smart, doctor, lawyer, whatever, but it's a specialty in picking those assets. So back in the old days, you had to be ultra wealthy. Maybe you buy a couple buildings, or you found some partnerships that you could club deals with. But it was really, really hard for individuals to invest in real estate. Today, there are multiple ways for individuals at various income levels to actually get good quality commercial real estate. So what are those ways? Well, one of the ways it developed, was the publicly traded REIT sector. So you can go out and buy real estate investment trust. These are basically just companies, and the companies have managers, and they go out and buy institutional properties. Some buy office, some buy industrial, some buy healthcare, and you can just buy it like you buy a share of IBM stock. Now, they work a little bit differently than stocks because the vast majority of the return has to, by statute, actually come from income distributions that come out, but it gives you exposure to real estate. You can diversify through individual stocks, through mutual funds, and through ETFs. Now, those are good. I'm a very big proponent of real estate investment trust, but the real estate investment trust world is pretty small. It's like the size of 3 Facebooks. And because of that, and because it actually is just an equity, you get a lot of the volatility or the movement, that daily movement that you get in the stock market with real estate investment trust. Over a long period of time, if your investment horizon is 10, 20 years, you're going to get the same kind of return you would get holding real estate directly within the stock market, but you're going to get a lot of volatility in the meantime. So if you're getting closer to retirement, you're worried about drawdowns, there's some potential factors that you at least need to consider when you're investing in that particular.
Yeah, that's what I was going to say. A lot of those, they trade just like a stock, right? So if you want to,
Yeah.
I mean, you can buy them in an ETF format or a mutual fund format, so you can get some diversification in those, or you can go out and buy the publicly traded REITs on their own. But yeah, you're right. You do get the stock movement, so you don't really get the protection there. So there's a private side of the real estate that you're not getting all that movement. It's not traded on a daily basis. It's not liquid every day. And then that has some advantages. Can you talk about that?
Well, it sure does. I mean, just because somebody tweets something or one data point comes out in the economy doesn't mean that the value of your building changes. I mean, the value of a real estate building is based on the magnitude and the stability of the cash flow. And that thing isn't changing tick by tick by tick. Therefore, if you own real estate privately, your values are going to only change when the economy changes, which affects how much income that particular building can generate, the stability of the income that building can generate. So they just don't move like a publicly traded vehicle, which really can dampen the volatility of the portfolio. Again, in the old days, if you had to try to buy building by building, really tough to do. But today there are pooled vehicles available where you can invest in a broad base of private real estate where you can buy the office, industrial, retail, and multifamily and get institutional quality real estate, but you can do it for a small dollar value. And there's a couple ways that you can do that. One is through real estate investment trusts that are non-traded. So you go out and you buy a share, if you will, of a defined set of assets. Maybe they're still buying assets. It's not fully defined, but you buy a pool. Maybe it's an industrial REIT, for example. It's not publicly traded. You buy it, you put your money in there, and the income that those industrial properties are kicking off are paying dividends to you. And at some point down the road, maybe they'll sell those properties and return your capital. Maybe they'll decide to list them on the exchange, and you can decide whether you wanted to keep them on the exchange or not. That's one way. More recently, the idea of a more security that almost looks like a mutual fund or an interval fund has developed, where individuals can invest in the exact same private real estate investment vehicles that pension funds and institutions and endowments invest in. So, for example, to kind of back that up, you take any one of the big states, CalSTRS, Texas Teachers. When they want private real estate, they'll go to a big company. They'll go to a company like Prudential, or they'll go to a company like AEW, or one of the big household names, CBRE. And see, these companies put together pools of 10, 15, $20 billion of real estate. Now, it used to be that 10, 15, $20 billion real estate was only available for someone like a Texas Teachers to invest in, or somebody like a CalPERS to invest in, or a sovereign wealth fund. Even a rich individual couldn't invest in them. But through this advent of interval funds, there's a way where the people can get together and invest in the interval fund. The interval fund itself, the fund itself, can become the institution, can become the Texas Teachers, if you will, and therefore take those dollars from mom and pop and invest in that 10, 15, $20 billion real estate pool. So now all of a sudden, maybe for $2,000, $3,000, $5,000, $10,000, you now are invested in the best real estate in the best markets, diversified by office, industrial, retail, diversified across the United States or even potentially globally. And you're sitting right alongside some of the best institutional investors. That didn't exist before long. That solves the problem of, hey, I got to try to go buy a rental house and somebody broke the lights and I got all my eggs in one basket. It solves the problem of I got all my eggs in a liquid basket that's moving tick by tick. I get that slower, less volatile movement and access to really good type of real estate that people have wanted over time.
Yeah, the idea of buying rental properties and running those is alluring. You can get some good tax benefits along the way. If you get the right tenants at the right times, you can make some decent money doing that. The struggle that I've seen happen over the years is people will own that real estate, they'll get into their retirement years, and you know what? They're still working because they have to keep managing the properties unless they're willing to part with some of the cash flow to hire a property manager. But they still have to keep track of everything that's going on. So what you're talking about is a much more passive approach to try to get a similar result of going out and buying the real estate direct.
Well, that's right. And I guess I would even take the analogy one step further. And I agree with you completely. One, it's terribly labor intensive, but it's also putting all of your eggs in one basket. So, you would never go, well, the biggest part of my portfolio, say, is stocks. You would never go, well, 100% of my stocks are going to be in IBM or 100% of my stocks are going to be in Facebook. For an individual that says, listen, I want my real estate exposure to be in that one, apartment complex or that one office building, you then have basically said, my third largest asset class I'm investing, I'm going to put all my eggs in one basket. I, as a non-professional doing something else, I'm not going to be in charge of running that, like in charge of running Facebook. It just doesn't make a lot of practical sense. Doesn't give you the diversification. There's a lot more risk involved as well. It's just simply, it's just so management intensive that it doesn't make sense. And having professional management select the assets, manage the assets for a minimal fee, generally speaking, those benefits way exceed the cost that management would charge for.
All right, so let's talk about Randy, the idea of the private real estate, like you would find in an endowment fund or a teacher's pension or something like that, and how does that react in an adverse economic condition versus the publicly traded REITs, where maybe you get a similar result over the long period of time? But you mentioned a word earlier called drawdown, which means simply, if the asset value starts to fall, how far does it drop before it stops falling and then turns around and starts going back up? Does the private real estate that you're talking about act differently than the publicly traded REITs?
Well, it does a lot. So the first thing is that the public market will respond first, and it will draw down more and further. It's sort of like, I always think about, rubber bands and things correct. No, nothing ever kind of gets right to equilibrium and then fixes it. It always overcorrects from one way to the other. So when all of a sudden people become concerned about real estate, and you can trade it real fast in the public markets, and say the value was 100 and the true value, say, is 80, it's not just going to go to 80 and stop. It's going to go down much further than 80. So you're going to get this idea of hurting. You're going to get this idea of selling. You're going to get all this behavioral finance where people just want out of it, driving the price way down below an equilibrium value. On the private market, the value is just the value. It trades at what the underlying fundamental value is. I think the best way to sort of think about drawdowns is to sort of think about all the years in which private real estate data exists. So, really private real estate data didn't start to come to be about 1978. It was an organization that came together and put together private data for these exact kind of institutional real estate funds that I talked about. If you go back to 1978 and you look just at private real estate, I think one of the most Compelling statistics is that there's only been 4 down periods in that over 40-year time period. I mean, 4, that's very, very few. And 2 of those down periods were during the global financial crisis, which was a real estate led. So, you sort of get away from the global financial crisis, and the other 2 periods were barely down at all. So really the only main drawdown you had was the 1 year that was the worst year in the global financial crisis. And you were down, 15, 16, 17% in high quality commercial real estate. Now, that's not great. We don't want to be down at all, but that's not down 40, 50, 60%.
Right.
And it bounced back up real quickly. And the funny thing is, because it wasn't over levered, these funds didn't go under. They weren't, sending the keys back to the bank and going, I'm out of the deal, or walking away from houses like you saw. The funds survived, they grew, and they went way back up over their value because they weren't over levered. They had the right properties in the right markets, and the income return still stayed in place. So while the appreciation, the value if you had to sell it today was less, they were high quality properties in high quality markets. People still needed to work, people still needed to live, they still needed to shop. And because of those things, they were still tenanted largely, and the occupancy rate stayed pretty good on high quality institutional properties. So if you stay in really good properties and really good markets and don't over lever, you get a drawdown that's so much less than you would get on the public side, and you get a nice recovery on the when the economy turns back around.
Well, and I think the other important thing to point out is on the private real estate, if you're investing in it for income, and we go through an economic recession, and let's say maybe the assets or the real estate is appraising at a lower value, your income may not be going down much. In fact, your income may stay the same. And so if that's your investment purpose, you really don't have a reason to turn around and say, gosh, get me out of this thing, right?
Well, that's really what the institutions do. When they make an allocation of real estate, they're not making it tactical. I'm coming in today and I'm out tomorrow. What they're saying is, hey, I'm buying good quality stuff. Over a long period of time, the trend line's going to be up. I'm going to get strong income. I'm generally going to grow at the rate of inflation. So you're going to get a nice, 5-ish kind of income return typically on real estate. You'll get 2-3% appreciation over time, not every year. So what if 1 year it's bad? What if 1 year, it marks down? What if it's down 2, 3, 4%? Well, you're still getting the income. The value's still there in the buildings. As you get to the other side, as we started the conversation with economic contraction and expansion, the contractions are always followed with the expansions, and as long as you don't have to get rid of the property, you don't have to worry about refinancing it. You have enough capital to keep it working. Those values are going to go back up. And in the meantime, you can collect your check. You can kind of live to fight another day and go. You know what? It's almost like buying a high quality bond. So you buy a single bond, it's marked to market in a day. It's bad if you're not selling the bond. So what? As long as it's not going to default, it's going to make it back up to value. In real estate, chances are you're going to get a nice distribution, and chances are you're going to end up with a value not just back to par, but above par if you can wait long.
Exactly right. All right, so let's switch this from real estate. Those still tie into real estate a little bit, but you talked earlier about how 70% of our gross domestic product, which is all the money spent in the United States, is based on consumer spending. And you talked about how you got full employment, and typically if you've got full employment, it's very difficult for the economy to grow. I want to change to demographic trends, and I have this theory that when people get married and have babies, that they automatically spend more money, and the more kids you have, the more money you spend. And we've got this massive millennial generation that en masse has not yet started to get married and have babies. So are we in a scenario potentially where you could have this massive population begin to get married and have babies and buy houses, where we don't necessarily have to have strong job creation or more people creating jobs, that just these people are going to have to spend money on the babies when they have them, because they're going to need to buy a house and all the things that go in the house and the strollers and the diapers and all of this. Is there anything to my theory there, Randy?
What I like most about your theory is it gets away from what people like to talk about is random paradigm shifts. So they talk about those under extreme economic conditions, and rarely do you actually have paradigm shifts. So, you speak about this, millennial generation, and, you read articles back consulting shops that say, oh, millennials don't want cars. They're never going to buy cars. Well, they didn't buy cars because they didn't have any money. The economy was in a bad spot. They were buried in student loans. Today, they have the same amount of cars that the last couple generations have. They say, listen, they don't really want to have big houses. They want to have houses that are small and green and energy efficient. Well, that's not true either. Now we're back to building houses that are just as big as they were before. So what you're really talking about, in my mind, and why I would agree with your theory, is that fundamentally, structurally, nothing's really changed in the ideal of what people are looking for in terms of life and how people sort of spend money throughout that life cycle. And through life cycle savings and investments and spending, really nothing structurally has changed in that market. So I would tell you that, there's certainly different tastes and preferences, people wanting to be closer. There's different kinds of cars, different kinds of fashion, but the basics of, hey, I'm going to get married. I've got to buy a house. I want that house in a particular school district. I need a different kind of car. I'm moving up in my job. I need a better suit. All these things that create spending, which is a multiplier effect, those things haven't changed and are very positive to the economy, and so we're going to get some of that benefit. Now, some of that is marginally offset globally by just simply the overall percentage of people in the working population is slowing. So it's slowing in the US, it's slowing in Europe, slowing in Asia. So all that's true, and I think that'll help offset it because of the nature of the age of the population within that working group is really the age where they get the biggest bump in spending, and that'll, I think, offset some of the risks that people show when they just show that larger demographic chart of just less growth in that working population.
So the millennials could actually wind up being our saviors. Then is that what I'm hearing?
That's funny. There's been so much, there's been so much said to the negative. I've got, but I've got some faith that the millennials will create some good jobs, some good companies, and create some economic growth as we go.
Well, it's interesting because I've created 5 millennials myself, and 3 of those are now out of college and on their own and doing well. And in fact, the oldest is married and buying a house, and now they're talking about having a baby and, buying new cars. And so doing all the things that, we did when we were younger. And it's, I think that trend continues, and I look at their friends and what they're doing, and it's a very similar thing. And so, yeah, the millennials have gotten a bad rap in a lot of ways. And, some of it maybe is deserved, but I do think that they're, like you said, they're going to be normal people. They're going to, they're going to raise families, and they're going to do the things that we've all done, and that's going to spur on the economy.
Yeah, I mean, I've got kids that are just slightly younger than that age group, but I got a son that's a sophomore in college and a daughter that's a sophomore going on junior in college. And the things that she wants, going to college, and the job that she wants, and the house that they want, the life they're looking for, it's no different than the things that I was thinking about here now. I'm an old guy in my 50s. And, I don't see them looking for a lot of things that are all that different, really. I mean, maybe the styles, maybe the things around the edges, but they want the house, they want the families, they want the vacations, they want the success. And, they want the family dynamic that I think generations have looked for. So I don't think a lot's changed there, and I think we'll see some growth.
So I like the way that you put the whole rubber band example. You things expand to a point, and then when they contract, they come back too far. And so when we look at expansions and we look at contractions in the economy, I always tell people those are not things to be feared. They're things to be understood, because in both expansions and contractions, there's opportunity in both cycles if you know what to look for. So in a contraction cycle, what would you look for that would be an opportunity?
Well, I mean, it's fantastic because, I think about this a lot. I was doing a lot of presentations around 2008, and people are like, well, what do I do? And what I said was, and I actually did a research paper on this, and I said, you don't have to be perfect. You don't have to find the exact bottom. But when all of a sudden real estate's trading below replacement costs, which basically means you can't build new product. So going back to that basic supply and demand, if real estate's trading below what it costs to rebuild it, you're not going to see new supply. So as demand grows, as your economy is picking back up, the existing properties are going to get more and more and more valuable. It's going to be a long time before you can have more supply. So I always look at what's asymmetric. You get in a situation where real estate's below what it costs to build. You know what? Maybe you're a year too early. Maybe you're 6 months too early. Maybe you're 2 years too early. But you're buying with asymmetric risk to the upside. You can do this even in the publicly traded REIT market. There are times in the publicly traded REIT market, because of whether it's sentiment, whether it's something the Fed said, that the values on the public side, if you added up all the values of all the properties, say they were worth 100, you might be able to buy for 80. That's a great opportunity. That's a rubber band that's snapped too far in the other direction. Or it might be the other direction where people just get too excited about real estate and the real estate's really worth 100, but the public market says it's worth 120. That's a time when you want to get rid of some of that public exposure. When the rubber band steps too far, the beautiful thing is you get asymmetric opportunities to make money. And that's where you get your alpha. That's where you get your, which is better, basically a good risk adjusted return or outperformance, because the deck in a way is stacked in your favor.
So one of the things I think that people have a tendency to do, I call that we live in this kind of drive-through mentality society, right? Where we want things to be fast, we want it to be easy, we want it to be cheap, and we don't want to really have to work too hard for anything. And when you're talking about the economy, it doesn't move fast. It doesn't move quick. Yeah, maybe there's some volatile moves out there in the markets every once in a while, but people have to be patient and they have to take the long-term approach. Can you talk a little bit about the patience that are required in real estate investing?
Yeah, I think patience is very important. I think, and I think even the global financial crisis told you that, because you go to some of the most beat up markets, and if you could have been patient, you're now back in the money and probably made a pretty decent return. The idea is in real estate and investing in general is, be aggressive when people are fearful, and and always be sort of a contrarian. But in order to be a contrarian, you have to invest in a way that doesn't force you to do things at the wrong time. So again, it goes back to some very simple principles. If you want some real estate, be patient, buy something that's always in demand. Well, what does that mean? If it's an office building, be close to the jobs. If it's multifamily, be close to the good schools. If it's retail, be close to where the households are. If it's grocery store, be close to where the households have good income. Be on the side of the road where people drive by so their milk doesn't get cold on the way in. Do the things right, so you buy things that have the demand. Don't over leverage, so you're forced to sell. Having to sell something at the wrong time is the major way to get hurt in real estate. To be patient means to be cautious. It also means don't take a bunch of risks. Don't get caught up in the idea that if I just put on a little bit more leverage, or if I just go to a little worse market and get a little higher return, or if I can just do some development, I can get these 20 and 30% returns. Maybe you can do that, but over a long period of time for the average investor, it's much better just to buy good quality core property, click that income coupon, keep the leverage low, and let that be a part of your portfolio stabilizer. You can be patient in that environment. If you're doing development and all of a sudden the economy goes in the other direction, maybe there's no money to finish the project and you're left with a half-built building. Maybe you go out to Florida where I used to live, and you see these neighborhoods with 500-600 houses. They built 4 spec houses. The economy tanked. Somebody bought one of those 4 spec houses, and they're in this vast wasteland. Those are never coming back. So when you do all those speculative things a little further away from the jobs, a little too much leverage, that's when you have a problem. Not just in real estate, but assets in general. Stay where there's good quality demand. Stay where there's core. There's a reason for the business. There's a reason for the cash flow generation. The cash flow can be protected.
Well, I think that this has been an absolutely fascinating interview, Randy, and I truly appreciate you spending time. And I want to just really let everybody know that the ability to invest in good quality commercial real estate is there today like never before. And I want to close with just a comment, and I want to get your thoughts on this. I recently had an opportunity to take an executive course at MIT, and I was out there for 3 days and had a chance to visit with a lot of the professors and even spoke with the dean out there. And I didn't understand. I mean, I knew that MIT and Harvard and Yale and all these big colleges, they own a lot of real estate, but the amount of real estate that they own that's right there, and the attractiveness of those institutions that are bringing in the biotech companies and the tech companies and all the jobs and everything. I mean, they've taken this idea of investing in real estate in the right place to, the nth degree, where they're owning that real estate in the area where they are, and they understand it. And in fact, I think if you look at Cambridge, you're going to find the vast majority of the real estate in Cambridge is owned by either Harvard or MIT. So talk about why they would do that, how it helps their endowment funds, and then once again, circle back around to how the individual investor has the ability to invest alongside these same types of institutions.
Yeah, I think a long time ago, a lot of the people that ran the endowments were academics themselves that sort of advised on where the good risk-adjusted returns were and how the universities could support research, how they could support students, how they could really support a lifestyle of the university, which is not so much different than the lifestyle of a person, just magnified by a great amount. And all the research showed that real estate was this great asset class. So for one thing, they wanted to control their own real estate so they could control their own modes of delivery. But if you actually look at their allocation, even outside of the real estate they own, in this particular case in Cambridge and Boston, they have a huge percentage of the money that they have in real estate outside even of those markets. They're investing in these exact same private institutional funds that are diversified all across the U.S. So, more often than not, an institution that has all the options in the world, they can invest in these fancy hedge funds, or they can invest in, any kind of private equity deal you can think of. They have a tremendously large allocation to private real estate investments because of those risk return characteristics. And I think that's the best endorsement of it all, because they have unlimited options. When you have billions of dollars to invest, everybody wants your money. And when everybody wants your money, you can dictate terms, you can pick the assets, you can pick the markets, you can pick the managers. And for an individual to sit there and say, listen, I can invest alongside someone with unlimited options, it's kind of a good housekeeping seal of approval. You're probably investing in some assets. They're going to make sense over the long term. Again, as long as you're patient like those institutions are.
Yep. No, I totally agree. So fascinating talk. All right, one last question. I thought of something else here, which I think is interesting. So several years ago, and I guess this all came after the .com bubble, when people were getting fearful of putting money in the stock market. They started wanting to buy their own individual real estate. And so this advent of, I can take my IRA money now and I can buy real estate with that IRA. I'm not sure if you're familiar with all the complex tax laws that surround that, but it can be an absolute nightmare. So I think that what we're talking about here today, Randy, is the fact that people can own real estate inside their IRA with some of the new programs that are out there today without having to run the risk of the complex tax laws that go with buying individual real estate inside of your IRA. You want to address that for just a minute?
Yeah, I mean, the tax laws not only are complex, but they're ever changing. And you also end up in a situation where you're not diversified again. So in these new programs that we've sort of been talking about today, you get invested in these large pool of real estate, 2,000 to 3,000 properties wide. You can do that within your IRA, just like you can buy a share of a mutual fund, but you're getting this exposure to private, not just all those publicly traded real estate, this nice, good, solid, slow-moving private real estate. And the easy thing is, you roll around in January and you get a 1099, just like you would with any sort of simple investment that you make. You don't have to go through your K1s. You don't have to be nonstop working with your CPA to figure it out. You're getting your nice 1099. You're getting timely reporting, and it can be. In many cases, these can even be, depending on the particular vehicle you invest in, also tax efficient. So, whatever product you're investing in, obviously your clients will talk to you and they'll look at it. And a lot of these new programs today actually have quite beneficial tax treatment. A lot of the dividends come back in very favorable ways that even provide some of those same kind of tax advantages that you look at and want. You can do that inside or outside the IRA.
All right. Well, thanks again for your time, Randy. If you don't mind, I want to keep you on my short list of people to interview again. This was fascinating. I know there's a lot more we could talk about, but we're going to wrap it up here. Thanks again for joining us on the Guided Retirement Show.
Well, it's absolutely my pleasure. Enjoyed talking with you, and definitely keep me on your short list. Glad to come back anytime.
All right. Great. Talk to you later. So that was Dr. Randy Anderson, and a lot of great information there about investing in real estate, overall economic conditions. I want to make sure that you check out the show notes here on the Guided Retirement Show at guidedretirementshow.com/23. That's guidedretirementshow.com/23. And also just make sure that you're sharing this information with all of your friends and your family. I hope you enjoyed today's program.
Investment advisory services offered through Barber Financial Group and SEC registered investment advisor.